Well, good morning, folks. My name's Lars Toomre. I'm joined here by Allan Mendelowitz. We're going to be covering session, I believe it's called 18A. It's on the digital transformation of the federal financial regulatory system. It's a process that we've been on for maybe 6 years or so. It'll take another 5 or 7 years before we finish boiling the equivalent to the Pacific Ocean, but we will eventually get there. We're going to talk a little bit about what the Financial Data Transparency Act involves, and then we're going to give some clues about other things that need to be done, because FDTA is by no means the last step. It's actually the first step of what should have been done about 30 years ago. And we'll give some clues in terms of where that is. I'm going to ask Allan, maybe you want to spend a moment and introduce yourself, then I'll go ahead and introduce and start with our presentation. How's that?
Sounds good. I'm Allan Mendelowitz, and my first request is to make this a little more cozy and comfortable. If I can ask the people in the back to come forward some more, I think don't be inhibited, but come forward. I mean, it's not a big crowd, and it would be nice to have everyone a little closer as we carry on the discussion. Fantastic. Appreciate all the volunteers. Great, thank you so much. I really appreciate it. That's better. Don't feel so lonely up here. My name is Allan Mendelowitz. I am the president of the Actis Financial Research Foundation. And what we've done in this foundation is to create an algorithmic financial contract standard that is open source and royalty free, and provides the capability to totally transform the organization and data operations of financial institutions and the very nature of financial regulation. But we can talk about that at some later date, meaning a little bit later in the hour.
Yep.
And so, and basically I'm a recovering economist, started out life as an academic, moved to Washington as a Brookings Institution Economic Policy Fellow, wound up taking some jobs in government, and the last position I held in government was the head of a financial regulatory agency, which was quite an eye-opening experience. So we'll talk about that later in the hour too. But thank you for coming, and hopefully what Lars and I have to say you'll find of some value and some interest.
I'm going to start off by saying Allan did himself a little bit of discredit. You know, there was something called the Chrysler Loan Guarantee Program back in 1979. He's one of the 3 guys who negotiated it. I mean, he's not very qualified in the subject. I'm Lars Toomre. This is my, I think, 11th year I've been here at CDOIQ. Remember when we came in and very small crowd, and it's grown bigger and bigger over the years. I'm primarily here because of a fellow by the name of Richard Soley, who was a classmate of mine at MIT, who headed the Object Management Group, which is a big standards organization for technology. Richard, unfortunately, has gotten some illness, so he's no longer actively available to participate with us. But Richard and I were here in 2020 with Richard Robinson talking about some of the same stuff, but it was 3 years reversed, or 3 years earlier than what eventually became passed in the last year is the Financial Data Transparency Act. I'm an MIT engineer officially. Graduated third in my family, to third generation to graduate. And I'll tell you from the start, I'm going to make a mistake. I go right away into, because I'm so used to engineering, I went to Wall Street back in 1983, and I'm the kid who figured out how to write the programs to cut and dice mortgages. So you remember that thing called collateralized mortgage obligations, and inverse floaters, and you know, all that funny language? That's me. And I make the mistake often when I start talking of using acronyms. So if I use acronyms today and you don't understand what I'm saying or don't understand what Allan's saying, please raise your hand and say, can you explain that one? You know, it's okay to say, I don't understand, okay? So please go ahead and do so. I wanted to start off a little bit, you You'll see a little bit about what BRC does. We're involved in insurtech, we're involved in fintech, we're involved in regtech. And those are kind of the three areas of merging technology together with finance. In my history, I ran the underwriting for enterprise risk management for Munich Re, which is the largest reinsurer in the world, where we take on the enterprise risk type risks of like the Canadian Wheat Board, which was like 10-year treasury risk, wheat risk, and crop spoilage risk. You know, if you can imagine pricing the three of them together, they encourage us to think that, you know, because they're non-correlated risks, 1 + 1 + 1 should equal 2.5 in terms of cost. No, it didn't quite work that way, but that's what they encourage us to think. I have been very heavily involved with OMG. I used to run the Government Domain Task Force. Coming out of the Government Domain Task Force is a new standard called Standard Business Report Model. It's not finalized yet, but it's a way of associating semantic meaning with data in a report. So imagine you can take your typical balance sheet, income statement, or flow of funds report, and you can attach semantic meaning to that so that total assets as a semantic concept does in fact equal total liabilities plus shareholder equity. Now I know the SEC has been requiring XBRL for about 15 years, but do you know there are 100 reports where total liabilities and shareholder equity did not equal total assets, and they were accepted as actually true reporting. I mean, I think, you know, double entry accounting is still existence, but you know, it's been pretty interesting how, you know, these good reports, quote unquote, get screwed up. We're trying to help address some of those issues so that you can apply consistency in the reporting and you can apply security within the reporting rather than just tagging the labels, okay? We are in the process of helping the government, and I'm not sure when I say what part of the government we're helping because there's different factions, go forward and potentially issue a central bank digital currency. The Fed has issued a white paper and they asked for responses. I helped with OMG in writing one of the responses to that. There's clearly going to be another session coming back out on it. It's also pretty clear that the government itself is not going to issue what's referred to as a retail CBDC, but the institutional CBDC is going to be probably coming, and it's probably going to end up coming through what I'm going to refer to as ANSI X9, which is the American representative to the ISO committee. I've moved over from OMG at the request of Treasury to be on ANSI X9 because I'm one of the doubters of saying a CDBC isn't going to work. Okay, just so you know where I stand on that subject. We're doing a lot in the area of discoverability of government statistics, ESG type data. How are you going to attest to ESG data? The Europeans are much ahead of the Americans. I'm not sure really what data they're asking to attest to, and how you're going to decompose, let's say, IBM's international operations in terms of the attribution of ESG to each individual country is an area which we're not even prepared for really dealing with yet, nor is the accounting industry ready to take it on and do the representations that are being asked of it. Secure and trustworthy elections, machine learning, AI, we have a lot to talk about in terms of that area. And then algorithms for delivery of government services, i.e. blockchain, more efficiency of, for instance, healthcare or welfare benefits. Why should we be turning around sending out checks? Why shouldn't we be just delivering it to a card or to a phone? Let's see, does that work? No.
Yeah, I saw the...
No, it still hasn't advanced.
Oh, no, that's the pointer. You just...
Oh, I'm sorry. I hit the wrong thing. This is Actus.
Okay, great. When you talk about data, I think there are sort of three primary areas of discussion and focus. One is data management, The second is accessibility and transparency. And the third is, what can you do with the data? Now, one of the challenges I think that data people have, and I'm going to talk now about financial institutions because that's my primary focus, and it's what I'm more comfortable talking about because I know something about it. When you talk about data in the financial institution, I think you have a real challenge because the wording and the language used by data executives and data managers doesn't translate into something that the traders and the business people understand or think is useful. It's almost as if the business of the financial institutions and the efforts on the part of data managers are like two ships passing in the night. They don't communicate. If any of you are out there in the data operations at a financial institution and you've had better luck at talking to the business people, let me know. The real problem is this, I think. You can't have really effective management of a financial institution without really good data management that ensures that the data is accurate, that the provenance is verifiable, that as time goes by, because financial contracts and instruments are long-lived, that the information remains current and correct over the life of the instruments that you're holding the data on. Unless you have really good data management, the people on the business side don't really have a good foundation in which to do risk management, transaction processing, pre-trade analysis, asset liability management, take your pick. And the interesting thing is the business people just don't know and don't care and are not interested. If you go to a trader and he's programming his trade so he can decide what to buy and what to sell, he's probably, or she is probably, programming it on Excel. There's no documentation to go with it. They're not versioning as they change it over time. And they violate every single critical component associated with good data management. So the question becomes, how do we bridge that gap? And bridging that gap really comes down to a very simple thing. The data people have to figure out how to talk to the business people and the traders so that they understand the value added that they're bringing. And I really think that what we're doing in Actis has some role to play in that in some way to help. The whole Actis project got started conceptually for me was when I was heading a federal financial regulatory agency. And nobody goes to school to be a regulator. You know, anybody who's in a federal financial regulatory agency, you know, gets hired out of college or graduate school or maybe out of a job at Wall Street after a few years. They get trained in-house. And what they do is really unique to the financial regulatory agencies. And because of a quirk in the federal compensation system, where if you work for a federal financial regulatory agency, you get paid more than other civil servants, they don't go anyplace else. They just circulate around. There's 9 or 10 federal financial regulatory, so they move around to get raises and promotions within that circle. So the same sort of culture applies. So coming from the outside, and notwithstanding the fact that I have a PhD in economics and I've testified on international financial issues scores of times, I really was, it took me a while to figure out what the supervisory staff was doing. And once I figured it out, I decided a big chunk of it was a deadweight loss. That's economic jargon for a waste. And the reason why is this. As a regulator, and by the way, financial institutions and markets are inherently unstable. I mean, everybody kind of figured that out because every few years they blow up and we have another crisis. But basically, as a regulator, we should be concerned about what happens tomorrow to the condition of the business we regulate, not what happened yesterday. After Silicon Valley Bank blew up, there were all sorts of great commentators who told you why Silicon Valley blew up. But unfortunately, from a regulatory perspective, that hasn't prevented the cost and the loss associated with the collapse of a $250 billion bank. So from my perspective, what a regulator wants to understand is, going forward, when the state of the world changes, what happens to the condition of the business? And much of the data that is collected tells you what happened yesterday. And what happened yesterday is not particularly interesting. And what happened yesterday doesn't help you prevent crises and collapses in the future. And so this is where sort of the Actis project comes in. We really had this vision that if we change the data that financial regulators collect, we can change the ability of the financial regulator to look through the windshield to understand what's going to happen tomorrow and what the risks of tomorrow are, as opposed to collecting stale, static, highly aggregated accounting numbers that talk about yesterday or 6 months ago. So how do you do that? Well, to understand what's going to happen tomorrow, you can never do with certainty, because the reality is risk is a constantly evolving phenomenon. But you want to be able to sort of model risk and, with your models, try to understand what might happen to interest rate risk, climate risk, behavior risk. There's all sorts of different risks that impact the likelihood that your counterparties and your borrowers are going to pay you what they promised to pay you. And so there's only one way to quantify the impact of risk on an institution, so in fact the regulators have some insight into what could happen tomorrow. And that is to have a common starting point. And for anyone who went to college and studied risk and uncertainty, there's that famous formulation that goes back 100 years. Risk is where you have known outcomes and probabilities associated with them. Uncertainty is you don't know all the outcomes, you don't know the probabilities associated with them. But in reality, in finance, there is something that is certain. And what
there is risk.
Yeah, there are two things that are certain. One of them is risk. But there is one thing in finance that, in fact, is certain. The building blocks of finance, the granular level, the molecules that the financial world is built from, are financial contracts. Everything in the financial world that's their business is a contract. If you take out a mortgage, it's a contract. If you take out a car loan, it's a contract. If you're an option trader, that's a contract. That's number one. Number two, those contracts reflect the fundamental uniqueness of the financial world, and that is, unlike car manufacturers and steel makers and computer makers, finance has no physical product. All that the financial contracts consist of is agreements to exchange cash flow. I go to a bank, the bank agrees to give me some money today, and I promise in the contract that I'm going to give them some money in the future according to the terms laid out in the contract. It's as simple as that. It's just, I get some cash, you get some cash. Every contract is the same. And what that means is, finance is nothing but numbers. And the way to represent a contract at the granular level is the best way to represent numbers. And that's mathematically or algorithmically, which is really interesting, because if you go take out a loan at a bank, you don't get some computer program that spits out what you're going to pay. You get a big pile of paper, and the paper, lays out and tells you you're going to borrow so much, and the interest rate is, and the day count method is this, and you're going to pay every 2 weeks or every month or every quarter. It lays out all the terms of the contract. And then when the time comes for the bank to implement it, the bank goes and puts all that information into their core processing systems, and that, in fact, is where the information is retained and where they keep track of who they have to pay and who they're going to receive. But the reality is, while everything is built up from these individual financial contracts, there is no standard way in use today where the contracts are standardized. And so what the Actis Financial Contract, what the Actis Foundation has done is to create an open source, royalty-free, algorithmic financial contract standard that in fact faithfully represents the payment obligations, the cash flow, embodied in almost every financial contract that's in the market. And I know what you're thinking at this point. There's thousands and thousands of financial instruments out there. What are you talking about? You can standardize thousands and thousands of different financial products. Well, if you look at the core cash flow obligations in a contract, it turns out there's very limited number of cash flow patterns. And in fact, within the Actis standard, we have less than 36 algorithms that we call contract types that represent faithfully and precisely, with respect to amounts and timing, the payment obligations of almost every financial contract extant in the market. And so the standard consists of the algorithms, which we've programmed we have technical descriptions, programmed in Java that you can download from our GitHub, and a data dictionary that precisely defines all of the contract terms. And it's this thing that has the potential for transforming the financial world. Because if you go into a bank, everything done in a bank that relates to their business is linked to the cash flow obligations. Every day their core systems crank out what they have to pay and what they expect to receive based on algorithms representing the contract. But it's all done without any standardized representation with respect to anything, which is why data in a financial institution is really a mess and so difficult to deal with. So that's one issue. But if you have a trader who wants to do pre-trade analysis, they need the same representation as the starting point. If you're doing risk management, you need the same starting point, which is the promised cash flows. Because the way you quantify the impact of risk is by assessing and determining the extent to which the interference of risk and uncertainty reduces the expected payments from what the promised ones are. And what that means, if you're a regulator, instead of collecting highly aggregated, backwards-looking, static accounting numbers with respect to the condition of the business, if you collect the granular transaction and position data and create a digital twin for the institutions that you regulate, you have the starting point for doing real-time enterprise risk management so that you can do forward-looking analysis as to what the vulnerabilities in the institutions are that you regulate. And on top of that, you can do something that can't be done now, which is you can model the entire financial world and look for the interconnectedness between the nodes and understand what the potential is for cascading risk within the system. Okay, go ahead.
This morning, the yield curve of the United States, 2 years to 10 years, it inverted by approximately 105 basis points. Okay.
The beauty of a soft landing.
Yeah, beauty of a soft landing. The challenge for almost everyone in this room is, what does that mean? How does it affect our financial system? Okay. We have virtually no standards internationally that will give you that answer. Goldman Sachs will tell you this. Morgan Stanley will tell you that. JP Morgan may think it knows the answer. Citibank definitely does not. Bank of America doesn't have the systems that can tell you even what the hell they own for cash. I mean, do you realize right now on a mark-to-market basis, Bank of America has more than $120 billion of losses they haven't declared yet? Oh, those risk management systems must be working really, really well. JP Morgan's doing pretty well. I think it's only $75 billion of negative losses not declared yet. What happened? Interest rates went up by 500 basis points. They bought 30-year mortgages. Okay? Yeah, the Fed's doing its job correctly of trying to, cut down on inflation, but, it's impacting the, financial regulatory system dramatically, or the regulated institutions, let's put it that way. We probably do not understand yet that we have another mortgage crisis on our hands. It's going to take us another 5 to 7 years, but we're going back to, experiencing 1989 to 1991 all again. But we're going to have RTC, and this one's going to cost $1 trillion. You know who owns the most mortgages in the country right now? Anyone? No, it's called the Federal Reserve Bank. All 3.2 trillion of them. Do you know how much losses there are in it right now, if you mark to market? Oh, it's only $1 trillion. On a mark-to-market basis, approximately. I mean, my numbers may be a little bit off. That's $1 trillion that's going to get sucked out of the Treasury because they don't contribute the funds to the Treasury. So the Treasury is going to net fund the Fed for some number of years going forward. We've got to change this. We've got to get the system to understand a little bit more on a real mark-to-market basis what's going on. So let's talk a little bit about what's going on with the current state of the environment. I want to jump down to the bottom and tell you with a couple of things. We need to get to a point where we have approximately 800 zombie banks, where if we were to mark-to-market the 4,300 financial institutions in the United States right now on a mark-to-market basis, forget about what they're holding to maturity. We have about 800 banks that are in a negative equity state. Those are going to have to be consolidated right now because they're not ongoing institutions. In the institutions between approximately let me get the numbers right. Approximately $5 billion to $100 billion in total assets. That represents something like 85% of the financial institutions in the United States. They've had a return on equity over the last decade of 2.2%. I don't know any equity holder who would want to invest for 2.2% for 10 years. And so when we have the commercial real estate stuff beginning to hit the equity holders, we're essentially going to have to consolidate banks. There's a big bank consolidation process coming here because you just can't finance enough of the business going forward. So one is we're going to have to do a better assessment and regulation of the individual financial institutions, particularly on the commercial real estate side and on the 30-year, 3.5% mortgage side, okay? America made the social or economic decision we're going to give people 30-year mortgages where they can prepay at any point with no cost. But we didn't think about the market cost that the whole society bears for whoever owns the other side of that mortgage, the pass-through or whatever as we go forward. We urgently need to get to near real-time enterprise risk management for our institutions. BlackRock, MetLife, I worked at MetLife back in 1995. We wrote an enterprise risk management system for the institution for the first time because we needed it. There was too much market risk, too much prepayment risk in the institution. So we needed to go through and model what was going on the asset side of the bank. We recently checked in with MetLife, and sure enough, they said, thank God you did it because we don't have as much risk as we did. We've shed risk as much as we possibly can. BlackRock, the largest fund manager in the country, they sell the Aladdin system to most of the large insurance companies. Fortunately, the insurance business is doing okay. I gotta say the banking system, I'm a little scared. The reason why I'm really even more scared is the introduction of digital assets. We've tried to keep digital assets out of the regulated banking system. Digital assets are very volatile in price, but even more so, digital assets can disappear from wallets. Think about the number of people you've seen, quote unquote, lose money, from a digital asset problem or wallet stolen. Now let me ask you a silly question. You've heard about fat finger problems, right? Let's say we wanted to do a $100 billion trade with JP Morgan. Fat finger, it's $1 trillion. And You can get $1 trillion out of the banking system if they hit the right JP Morgan wallet on the digital asset side. That's the real risk of things, in seconds, since we're only looking at things, 3 months, 6 months later. But how do we catch up with the thing which happened, I don't even want to think about how we protect the system, okay? And that's the scary part of where the current quote-unquote regulatory system is versus the risks that they're taking on or being asked to take on by Congress and people advocating we must keep up with progress. I'm not sure we need to keep up with progress because I think we're exposing ourselves to far many more risks than we can turn around and adequately manage given our current regulatory perspective. I worked for 7 years getting this law passed in various forms. It was finally passed last December, and it's designed to modernize all 9 of the federal regulatory agencies. Unfortunately, the CFTC was not included in this for reasons of cryptocurrency. And unfortunately, since CFTC is not included, it doesn't cover derivatives. Big problem. But where we are right now is we're quote unquote educating the system, and each one of the regulatory agencies are thinking about how they're going to help to modernize or define the terms that they need in their reports. As you can see, it's Treasury, SEC, FDIC, OCC, CFPB, the Federal Reserve System, the credit unions, and the housing agencies. Oh, and then there's something called the MSRB. That's even a little bit more convoluted because they're not technically regulated at the national level. So MSRB got swept in under the SEC securities laws. It's going to take a little bit longer, but they, for the first time, are also going to have to disclose their data publicly due to this law. Now, digital assets, as I was saying, just introduce all sorts of crazy risks. I'm going to talk with acronyms that some people may know or some people not. AML and KYC. AML stands for anti-money laundering, KYC is know your customer. Until we have digital identity, for every one of the things, you can hide behind things, and there's phenomenal amounts of terrorist financing, drug money, fraud tied in with the digital world. I am very leery of it. I think regulators are very, very leery of it, but the congressional staffs are pushing pretty hard that we're going to see something come forward saying you must adjust to a digital world. I hope the American system drags its feet as long as it possibly can because we're not ready for it. And we've got to get scrambling as quickly as we can to try and keep up with this digital asset world. There also are extreme operational risks lurking out there. And are we ready to have the quote-unquote problem if we issued a CBDC and all of a sudden $1 trillion disappeared from the banking system because someone stole the money? Doesn't matter whether they used it, but they just stole it. Are you going to take the reputational risk of the digital dollar and put it at risk because someone could steal that much? I mean, it's stuff that, from a policy perspective, we're not used to thinking about, we're not really even used to discussing. One of the key things, we heard it in the last talk, I'll say it in this talk, we don't have the appropriate skill sets yet in our financial institution employees for dealing with a world where crypto theft, digital identity are prepared for. Okay, we need to do a lot more cross-training for kind of where the world's going to with financial services. I was asked earlier this week, my prediction is that we're going to see the banking system consolidate quite a bit, and the non-banks are going to proliferate even more so than they have, simply because there's too much cost of the regulation, but the regulation is really what's going to protect the American system. I will talk a little bit about some of the financial regulatory developments. One is called FIBO, Financial Industry Business Ontology. This is where the computer geeks like me begin to start finally saying, let's say, help with some of the stuff which is going on. We have a term like total assets. It's a label which you see typically on your balance sheet, but it really represents a concept that it's the sum of all the assets that an institution owns. We need to semantically define it, and there I go using a pretty funny word, semantically. Semantically means that we're defining a term so the computer understands it in the same way a human being might. So it can read a report and say, oh, I see those total assets. I see the 100 number. I associate with it for a period that ends. It's in a currency, and it's doing rounding, for cutting off 6 zeros or 9 zeros or whatever the right number of zeros is, so you can see that number of 100 or 101.6 or whatever, and it's displayed next to each other. Well, the computer can understand it just like a human can. We need to deal with zero trust cybersecurity. We have very big issue, very, very big issue, and I don't think we're ready to start explaining it, is how do you do automated underwriting? And how do you prevent redlining in the models? Turns out that you have unusual biases in a number of these large language models because they're trained with college students, and college students are disproportionately white. So it tends to have a bias. If you've ever looked at image processing and recognition, it doesn't do very well on Asian or Negro Americans, partially because they just don't have enough sample. They have a much better sample size with white Americans. Similarly, you have similar biases, and it's been shown if you use automated underwriting, you tend to redline where in fact redlining historically has been done. And I don't know if people understand redlining is saying, okay, that's a poor district, so I don't want to underwrite in that district, or I have a bias against underwriting there because I know from historical fact that I don't want to be there. And it's very difficult to prove that in fact one is not biased. There's a famous case which the computer experts are having a real problem dealing with. There was a couple who separately, joint finances, a couple separately applied for an Apple credit card. The husband was approved, the wife was declined. Why? Can't explain it. That explainability portion of the AI underwriting is one of the big things we need to focus on, especially as we begin to accelerate with the AI introduction into processes, and can we really trust them? Similar things going on with fraud detection. You're having fraud being suggested in certain areas where it's not in fact going on. Other areas is under detecting it. So what's going on with that? Now, the other thing we absolutely have to do with regulatory developments, we have to move from this looking backwards to now looking forwards and sort of being able to predict things. And that's what we refer to, and you'll hear me talk about it, near real-time enterprise risk management. I say near real-time in the sense I don't really need to have yesterday's transactions. If I just had last weekend's transactions, I can get some sense for these large institutions of most of the risk they're under. So, you don't need to tell me, what happened 5 seconds ago. If I can just get last week's transactions, I have a sense of what's going on. So with that, I'm going to ask Allan to start talking a little bit about this funny chart.
Funny chart. What is this chart? Assets, semantic.
Okay, let's talk about this. Earlier I'd mentioned that what we want to do is, if you want really good financial regulation, you really have to focus on the capability of coming up with probabilistic cash flows going forward rather than looking at historical records. And this is really at the heart of what we're talking about doing. And what that means is we have to have data in a standard that enables the forward-looking analysis that we say we need. And we can abstract from all of the fancy terminology that goes along with data systems, ontology, and what's the other term you said? What's the other term?
Taxonomy you're referring to?
No, not taxonomy. The one where make the machine understand what people understand. What was that word you used?
Semantic data.
Semantic data. Yeah, I always have trouble with all these words. In college, the only time I saw the word ontology was in freshman humanities, where we learned about the ontological proof for the existence of God, and somehow beyond that, I never related. Remember what I said earlier, and that is, to understand risk to a financial institution and what the implications are, you have to understand how that risk diminishes the payments that the financial institution expects to receive. That's how you quantify the impact of risk. And what is the consequence of that? It affects earnings. If you take in less than you were promised, you're going to earn less. It affects the value of everything on your balance sheet and the amount of capital that you have, because your assets are going to be worth less than you thought they were worth if every penny that was obligated to you to be paid, in fact, was paid. And so you have to think, what is the standard that enables any kind of analyst, whether it's a regulatory analyst who's collecting data on the financial institutions to do enterprise risk management, or the risk managers, the chief risk officers at a financial institution that needs to be able to project the condition of the business and how to adjust to the risks that they've identified. And it all comes back to the same thing. You have to represent the molecular building blocks of a financial institution in a standard that generates the contractual payments, so you can then quantify the impact of risk by coming up with a diminished expected cash flow rather than the promised cash flow.
I'm going to just jump in for 1 second. What Allan's talking about is going from legalistic cash flows, which are obligated under the contract, to what I would refer to on the trading desk is the probabilistic cash flows. There's a probability that a mortgage will prepay. There's a probability that credit will default. There's a probability that there's going to be a shortfall from operational risk. And when you apply those probabilities to the whole institution, that's what the probabilistic cash flows are going to look like for the institution. And so when we talk about yield curve analytics, for instance, you'll start off with where the yield curve was back in January 1, 2022, and where it is today, and you can see, given the cash flows which have occurred, you can see how the front-end cash flows, the 2-year type cash flows, have gotten priced much more cheaply than the longer-term cash flows. Well, it turns out, oh, that's interesting, because most of the liabilities are 2 years and in cash flows. That's how you can show that an institution was going to go under if they hadn't, looked forward enough to see where it was going, i.e. Silicon Valley Bank.
If you take Silicon Valley Bank as an example, we at the foundation took available public data about what was on the balance sheet of Silicon Valley Bank, and we came up with a reasonably good approximation of the granular representation in the active standard of the assets and liabilities on the balance sheet of Silicon Valley Bank at several different points in time. End of fourth quarter 2022, end of second quarter 2022, end of fourth quarter 2021. That means December 2021, about almost a year and a half before Silicon Valley Bank collapsed, and then June of 2022, which was roughly almost a year before it collapsed, and then December of 2022, which was a few months before it collapsed. And we analyzed the impact, the forward-looking risks associated with rising interest rates on the balance sheet of Silicon Valley Bank at each point in time. And what we learned from this, and by the way, if you go back a year and a half, everybody who knew, you didn't have to be a sophisticated economist to understand, we had inflation. The inflation rate was too high. The Fed was going to raise interest rates. And based on past experience, interest rates were going to go up a lot. Okay? So we subjected the balance sheet to increases in interest rates at those 3 different points in time. What we found was, looking forward, in December of 2022, you couldn't save the bank. It was clear it was going to collapse. If you went back to June of 2022, you could look forward and see the bank was going to collapse. There was no hope for it. And if you went back to December 2021, which was almost a year and a half before it collapsed, there was incredibly slight possibility, if the correct actions were taken and the market was capable of allowing you to take those actions, which meant you could buy all of the hedges that you needed to prevent total collapse. Other than that slight possibility that if everything went right, you might survive, it was clear a year and a half in advance the bank was going to collapse. That is the kind of regulatory oversight that we need today. You know, we have a regulatory system today that reminds me of the Ptolemaic version of the universe. You all remember? The Ptolemaic version survived for a millennium and a half. It had the Earth as the center of the universe. And there was a problem because as years and hundreds of years went by, lots of very sharp-eyed people would, look at the sky at night and they'd identify all sorts of things moving around the sky that didn't fit into this model. So every time something new was found, they came up with a new epicycle to represent it, right? And they kept adding them and adding them and adding them. And they had this, ultimately this absurd system, which at the end of the day collapsed and was replaced by Copernicus and Galileo, who came up with an alternative that, in fact, was the way to look at the universe, consistent with the reality of what they were looking at. Well, that's what we've done with regulation. We started out before the 2008 collapse. The regulatory approach said, hey, we're going to do a good job regulating individual firms, and then the financial system will take care of itself. False. What we learned was you can't just focus on individual institutions because you have all sorts of potentials for cascading failures, the contagion associated with fire sales of assets and so on. So after the 2008 collapse, they said, oh, let's start focusing on the system as well as on financial stability of the system as well as individual institutions. Anyone who knows anything about financial crises always know that the triggering event is liquidity, your ability to access liquidity. Well, there was no regulatory component for liquidity, so we've layered on a liquidity funding ratio and a net stable funding ratio. And now Silicon Valley collapsed, so suddenly there are new requirements for capital, and you go on and on, you keep layering these in. And all of these are efforts to add some additional reporting requirements, some additional regulatory requirement to try to head off whatever the crisis was yesterday. In point of fact, it's time to bring Copernicus and Galileo to the table and let them come up with a better system for financial oversight, or if not them, the Actis Financial Research Foundation, which has, I believe, the answer, which is, stop trying to plug every hole in the dike with your thumb as it pops out, but come up with a data collection system that allows you to do near-time enterprise risk management on the institutions that you're regulating, so you can both look to the future and see what risk will do to their conditions, and you can also look at the interconnectedness in the entire market and identify potentials for cascading failures.
I'm concerned about our time and
Yeah.
the ability to help and let you ask some questions. But the key point, which I think both Allan and I are trying to communicate, is we can't be in a world where we look at static historical reporting to depend upon financial regulation. We need to go like the active participants do currently. we need to go to a standardized way of doing near real-time enterprise risk management, where you start bottom up, down at the granular level, or at least pooling of granular data. And so you represent the whole credit card portfolio as 25 billion, and this, at least starting from there. We need to start from the bottom up, where you can start doing scenario analysis of, right now, one of the highest losses you're seeing is in automobile loans. We were reading about it. They're above 2008 crisis levels. How does that impact people? That's the type of thing you need to be able to ask.
By the way, I want to make very clear, when we talk about standardizing things, we're talking only about those things that you can standardize. In this case, it's the payment obligations, the cash flow obligations in the granular financial contracts. What you cannot standardize are the risk models. And competition between financial institutions and chief risk officers and modelers of risk should be on the basis of coming up with ever increasingly better ways to model risk. Because if you standardize the representation of risk, which you can't standardize in my view, I guarantee you the next crisis will be caused by model risk. Because those, you put a straitjacket on how you model risk, you're going to wind up with things being missed, and you're going to wind up with the system blowing up because of model risk.
I want to open it up both to people here in the room, and if there are any questions coming in from the virtual audience that you'd like to ask. I see a couple of people interested, and it seems to asking a question. Would like to go ahead. Is there a microphone? Sorry. I think here.
Lars, it was good to talk earlier. I viscerally identify with everything you talk about. MLR, BSAR, IRR, I'm for one of those very large independent financial regulators.
Can you identify what organization you're with?
Let me think about my question first.
Okay, fine.
No, but I like the idea of the model, but can you say more about the uptake, the likelihood that this is going to get into place and actually be used by either the regulated institutions or the regulators?
This is a very long-term project. We have been with the standard we've created, and it was really, the original motivation was for regulatory purposes. And then later it turns out that it has tremendous value. The DeFi world is using it as the computational core for smart financial contracts on several of the blockchains. It's a good tool for financial literacy education. It's a good tool for improving the efficiency of bank operations, and it certainly is an excellent tool for improving regulatory oversight and supervision. And the answer to that is a year and a half ago, the FDIC ran a rapid phase prototype competition on better ways to collect data. And they invited 45 firms to compete, and most of them were, a few were startups, most of them were big consulting firms that work in the financial space. And our foundation got invited as well. And I have to tell you, it's a total volunteer effort. Everything we've been doing has been, volunteer work by people who really believe in what we're doing. And amazingly, a large number of the big companies got cut along the way. And our foundation, where our entry was done entirely with volunteers doing the project, we're one of the finalists. I mean, we snagged a $250,000 award for what we did. So we're making this kind of slow progress. We come to events like this in large part because I really believe that having the CDOs and the data managers separate from the analytics is a mistake. I think that you should have a unified operational component that is responsible for data management and analytics, because you can't do good analytics without good data. And I think that as more of that comes to the fore and people understand that data is only valuable in terms of what you can do with it and how much knowledge you can extract from it. So as we sort of move on this journey, I'm optimistic that we'll get there. As Moses said, or Martin Luther King said, you know, I've been on the mountaintop. Maybe I won't get there, but you'll all get there eventually.
In terms of data take-up, I think that we need to look to other nationalities, particularly Netherlands, England, Singapore, and a little bit Australia. They're much more advanced than the Americans are in terms of this process of moving towards prudent regulation. Brexit is causing the Brits in particular to focus on how they're going to do prudent regulation across the whole financial industry. And we're seeing lots of what I'm talking about and Allan talks about. We've been over to London quite a bit to talk with them, and they get it. Although we did the Financial Data Transparency Act first, and they're going to bring their own act behind it because they have so much of the derivative risk sitting in London. We're going to probably see that come first.
Thank you very much. I'm Director for Enterprise Data Services, the Comptroller of the Currency.
Thank you very much for your question. I really appreciate it. Other questions? Are there other questions in the audience? I want to make sure that we acknowledge, I know there are a number of people listening, including from like OFR and others. Any other questions coming in? I don't know how you'd see it.
There are no online questions at this time.
Okay, great.
I could add on one thing that we have interest in, which I think it's a little too late, but we're focusing on sentiment analysis. Which
Oh, incredibly important.
SVP was right to know that, you know, this guy was going down quick, you know, happened very quickly. So we're bringing that into the knowledge. But what may make us aware of what's happening today or tomorrow, it's too late in the game to make a change.
Absolutely.
The watchword is when a crisis hits, you're dead. You can't collect data in the middle of a crisis. You either collect the right data on an ongoing basis so you're prepared when the crisis hits, or you're able to at least reduce its severity, or you're out of luck.
I'll say off the record, but I should say my personal opinion, I don't know why the recent market disruption did not become larger more quickly. It's only limited to about 3 or 4 banks.
Yeah.
Syria.
Well, the one answer is the taxpayers bought it off. I mean, the reality is when you step into a bank and notwithstanding the limits of deposit insurance, you say everybody's going to be covered. Basically, the taxpayers assume the cost of preventing the crisis. And that, in fact, it's unfortunate, and there are other problems associated with it. But in fact, it may be an efficient solution in terms of loss of economic activity and reduction in potential longer-term exposure or near-term exposure. Longer-term, it could increase it. These, as you know, is better than us probably. These are really complex issues.
Well, with that, we'll say thank you very much. And if you have any questions, we'll be happy to entertain, afterwards. Thank you. We're trying to keep on time for the whole conference. Thank you very much.
Thank you.